Welcome back. Today we're going to talk about something that may seem a bit academic, but I think you're going to find it very interesting and it's very relevant and it's very unusual. You may have seen some headlines over the past few months talking about M2, the collapse of M2. What is M2? What is the measure of money supply? Well, first we talk about M1 and M2. They go together. M1 and M2 measure the money supply in the US. Very simply, the amount of money in the country. M1 represents money in circulation, cash, plus checkable deposits in banks. Think of the most liquid assets out there. M2, which is what we're going to talk about today, is M1, the most liquid assets out there, cash, plus savings deposits, money market mutual funds, also those securities that are very easily convertible into cash. That's very easy to move around as opposed to real estate's long-term real estate investments, long-term investments, other things that you may not be able to move. And the reason why we look at the short-term, or I should say the most liquid assets, is because those are the most reactionary. When something in the economy changes, it's very easy for us to take money out of our savings account or to move money from here to there. That's why we look at M2. Now, what has happened with M2? Well, we've seen for the first time in a very long time a decline in M2, a decrease in the amount of money within circulation in the US economy. We're going to talk about why this has happened. But take a look at what we're looking at, and this is the increase or decrease as a percentage from January 1st through December 31st of every respective year. This is going back to 1959. A lot of analysts have gone back a lot further than that. We're talking about, nearly a century's worth of data in some cases, but for our purposes, we go back 70, 80 years. We can see it is the only, yet last year, 2022, and especially this year, 2023, so far we see a 2% decline in M2, the most liquid assets out there. That money is being taken out of the economy, it's taken out of circulation. And just to put this in perspective, there were major increases in M2 when money was added to the US economy. Money is added to the US economy by means of the Federal Reserve. They lower interest rates, quantitative easing, special programs where they insert money into the economy, as a result of one crisis or another. And this is not unusual. In 2001, we can see there was a 9% increase in M2. In 2008, that financial crisis, there was also another 9% increase. Later on in 2011, there was a 9% increase. Now, as a result, in part of the COVID crisis 2020, there was a 24% increase in M2. Now, this is M2, the white line. The red line is the federal funds rate. And the federal funds is a tool, the interest rate is a tool that the Federal Reserve uses to control M2, among many other things. And there's a direct correlation. When the Federal Reserve cuts interest rates, when this red line goes down, it increases money into the economy. It increases M2. It makes it easier to borrow. It makes it easier to buy a new house, to invest. Essentially, we looked at, especially those years 2020 through 2022, and many years prior to that as well, we saw nearly 0% interest rates. Borrow money at nearly zero, invested, it's all upside. Well, one of the results of this is a drastic increase of M2, and we can see it has moved exponentially. Now, these numbers, by the way, they're denoted in tens of thousands. It's actually a much, much larger number, but we reduce the decimals, just for the ease of, talking about these numbers. Take a look at M2, which is the white line again, and this is the inflation rate. This is measured by the CPI. We talk about it all the time, Consumer Price Index. It's very easy to calculate the CPI inflation rate on your own. You just take whatever it's released most recently the past month, and go back exactly 1 year, March to March, April to April, and just calculate the change. We want to see a year over year basis how much the inflation rate change. Most recently, the inflation rate was reported around 3.1%. This is after hitting levels of an 8.9% inflation rate. That was reported in June of last year. Now, again, we talk about June 2022 a lot. There's something we're going to talk about in a minute that's very special, very unusual. It occurred June of last year. Keep that in mind. But notice there is a delayed reaction. As M2 increases, then the inflation rate goes up. It's not an immediate reaction. They don't put money, they don't increase the amount of money in the money supply on Monday, and then, everything goes up on Tuesday. There's a delayed reaction. The spike in M2 occurred, really, we're looking at early 2020, March, April, May. Remember what was happening around that time of 2020. The inflation rate really didn't skyrocket until April of 2021. There was about a year's lag. Now M2 started to, top off over here, and very interestingly, also the inflation rate topped out at the same time. There's a direct correlation. Now there is a delayed reaction at times. Very interesting to see though that we hit the tops in our inflation rate and the tops in M2, virtually at the same time. And that was, late 2022. Also the tops of stocks, if I recall correctly. Now here we see the inflation rate, that's in yellow over here, and the S&P 500 in red. Now the S&P 500 moved ahead of the inflation rate. Why? Because the S&P 500 is all of us. We're trying to guess what corporate earnings are going to be next quarter because we want to make money. We buy a certain stock, Tesla, Disney, whatever it may be today, based on if we think it's going to have good earnings in 3 months. The market, the stock market especially, is a forward-looking mechanism. That's why when the inflation rate dropped and the stocks dropped March of 2020, well, the stock market took off in part due to the assurance that, well, we're going to have very cheap money. M2 is going to be increased. There's going to be a lot of money out there, 0% interest rates. Go out there, take the risk. It's worthwhile. That's what the Federal Reserve was telling us. Now, eventually the inflation rate did take off, but stocks moved ahead. The stock market really is, in many cases, really a great predictor of what's to come. There's economic theories by Milton Friedman that talks about the fact that the stock market is also, the price function is also a predictor. I'm probably not explaining this the right way, but that the actual price movement can be an indicator in and of itself. Very, very interesting how the stock market took off, and then the reported inflation rate came after the fact. Now, here's the question. I want you to take some time, if you like, chat in, leave a comment if you wish. Let us know what you think. I'm very curious to see what the net sum of the comments are. Did the Federal Reserve wait too long to begin to raise interest rates to combat the inflation? The Federal Reserve lowered interest rates, increased M2, increased the money supply. That led to inflation. How does the Federal Reserve taper inflation? They raise interest rates. Well, to help answer that question, take a look at the red line. That's a Federal Reserve interest rates. The yellow line is a CPI inflation rate. Now, notice what happened and keep this in mind. This is, I think, going to give you some help in answering this question. The Federal Reserve has a 2% inflation target. If the inflation is sustainably above 2%, Federal Reserve raises interest rates. If it's below 2%, they lower interest rates. Well, take a look to see the yellow line, the CPI, when that crossed above that 2% level. Well, March of 2021, CPI was reported at 2.6%. Now, you can say, well, maybe not officially. And I know these numbers are reported a month afterwards. So, cut them some slack. But the fact of the matter is, we see inflation 2.6% in March. We see inflation rates 4%. What was that? April. 4.9% in the end of May. 5.3% in June. The Federal Reserve still did not raise interest rates. The Federal Reserve did not raise interest rates until Mid 2022. March, actually, first quarter, March 2022, they went to 0.5% interest rates. Where was the inflation rate March of 2022? All the way up here. The inflation rate, January, no, March, February, March. March of 2022, the inflation rate was 8.5%. I thought we had a 2% inflation target. Why did they wait that long? That's the question. Let us know what you think. Did they wait too long? Should they have raised interest rates? Now it's easy for us, Monday night quarterbacks to go back and say, well, now I know what happened and I woulda, coulda, shoulda done this. Very interesting though. Do you think they waited too long? And here's some extra food for thought. The white line's the inflation rate, the CPI. And we know a very special something happened June of 2022. What else happened June of 2022? The beginning of the inverted bond markets. The red line is a 1-year US Treasury. The blue line is a 10-year US Treasury. An inverted bond market occurs when the short-term Treasury crosses above the long-term Treasury. Now, not every recession is predicted 100% by an inverted bond market, but every major pullback in the economy is preceded. Not every inverted bond market leads to, the Great Depression, but every major recession is preceded by an inverted bond market. The inverted bond market, the 1-year US Treasury crossed above the 10 June of 2022. Now, at that time, the inflation rate popped up and then 8.9% peaked, I should say, and then started to move to the downside as a result, in part, of the Federal Reserve raising interest rates. But here's the question. uh, you know, Aside from the other question, that the inverted bond market is a sign of something unhealthy that's happening in the economy. You see, the 1-year Treasury, the red line, shows us what the Federal Reserve is most likely to do in the near term future. For example, in a couple of days, we have another meeting. Federal Reserve is expected to raise interest rates again. Why? Because we're still above our 2% target, 3.1%. But the long term US Treasury, the 10-year, the blue line, is predicting on the longer term outlook, the economy looks even worse than it is now. And that is the nature, that's the mechanics of an inverted bond market. That's what the inverted bond market's telling us. Then the near term, higher interest rates, which we usually associate higher interest rates with a strong economy. Except when the long term interest rates are lower, it means that there's storm clouds on the horizon. Things might be sunny now, but not forever. So, we have a Federal Reserve meeting coming up this week. We have a slew of other economic numbers, GDP, durable goods, housing numbers. So we're going to be watching the economic calendar very closely. And please let us know, again, did the Federal Reserve wait too long to raise interest rates? Now, taking into consideration, the inflation rate was at 7-8% when they first started to hike rates. We're going to be watching the economic calendar and all this market action very closely. We hope this has been helpful. We look forward to seeing you back soon.